In this episode, we're diving deep into mortgage insurance.
So Grant, come across it all the time. Clients, clients' children, in a lot of cases, they go out, they make the biggest purchase of their life, they purchase a home. Now it's time to insure that home. When they're at the bank getting their mortgage, they're often given the opportunity to purchase mortgage insurance to cover off the mortgage in the event if something were to happen. However, often they'll even know an insurance advisor who sells life insurance. So sometimes it can be confusing in determining what you should actually do, what's better. So wanted to go into that a little bit today. In order to answer the question between whether or not you should get mortgage insurance versus life insurance, it's best for us to really examine the key differences between the two.
So yeah, there's really four major differences between what we call personal insurance, which you own yourself, versus what we call lender insurance or creditor insurance, which will be offered by your lending institution. The first major difference is on the underwriting side of things. So when we talk about underwriting, it's really talking about the process that's involved with putting life insurance in place, or any type of insurance in place for that matter. The key differences between mortgage insurance that's offered through your lender and personal insurance that's taken by you and owned personally by you is that with mortgage insurance offered through your lender, it's underwritten at the time of claim, which means that you technically don't really know if you actually have coverage in place even when you're getting it. You won't know until at which time as one of your family members wants to make a claim against that insurance, and at that point they're going to evaluate your medical history and things like that and determine whether or not you actually have coverage in the first place that's going to pay out. Personal insurance works exactly on the opposite side of that, which is when you first apply for personal insurance, whether that's term 10 or term 20 or universal life, life insurance coverage, doesn't matter. That life insurance is underwritten right up front, so you're going to know right away whether or not you have any coverage at all. And at the time of claim, there's no issue with underwriting. The policy is just essentially paid out. So it's a much easier process, and it's a much better experience for any of your grieving family members that might be going through the process.
With the underwriting on the mortgage insurance, where you're saying it's done at when a claim is made, is there any risk to doing it that way?
Yeah, sure. And frankly, if there's underwriting at the time of claim, you may not have any insurance in place at all. In which case, that means that you've been paying for premiums this entire time, and you might not even have any coverage tied to those premiums. So you might be paying for something that will never essentially pay out.
And at least with the life insurance up front, as long as you're truthful in your medical questionnaire and everything goes all right, you have the comfort of knowing that if a claim has to happen, that your family will be covered.
Exactly, yeah. So the second major difference between creditor insurance offered through the lender and personal insurance is on the benefits themselves. So typically with the creditor insurance through your banks or your lender, the benefit of the insurance is tied to the outstanding amount on the mortgage itself. So as you're paying down your mortgage, the level of insurance benefit that you have is also coming down at the exact same rate. Personal insurance, which you own yourself, works differently than that. In that, generally speaking, the benefits are level. So if you have $200,000 of coverage at the time you start the policy or apply for it, then you have $200,000 at the time right through, basically, the existence of that same policy. There are some personal insurance policies that do adjust as your mortgage comes off as well, but generally speaking, most personal insurance policies have a level benefit that will stay the same. So that can be of benefit to you as you're paying for this. You're paying for a higher benefit, and that's going to be there when you need it.
So Grant, with the mortgage insurance, what you're saying is you're paying the same level premium the whole way through, but actually the benefit that you will receive is declining. Versus with the life insurance, the personal life insurance, you're able to pay that flat rate, but again, the benefit stays flat as well.
Yeah, typically speaking, I mean, there's lots of different types of insurance out there, right? But typically speaking, the premium that you're paying will stay the same as long as it's under that select term or term around the policy, and then the benefit will remain the exact same as well. Again, typically speaking, because there's lots of different options out there. So the third major benefit that personal insurance has over creditor insurance through the lender is portability. And what's meant by portability is that, let's say, for example, you have a mortgage with Bank A. After 5 years, your term is up on Bank A, and so you decide you want to go move your mortgage to Bank B.
Mm-hmm.
Well, the insurance that if you took your life insurance through the Bank A offering, you can't take that Bank A offering insurance and take it to Bank B. It's not what we call portable. Whereas personal insurance, which you own yourself, it's portable to wherever you want because nothing's actually changing on the standpoint of the insurance company. You own it. You can take it whatever you want for wherever you want, and frankly, you can use that money to cover whatever you want. So portability is a key benefit because you're not going to be changing your insurance around all the time. And frankly, at some point, you might find that you're not eligible for insurance down the road. And so if you've already had it in place and it's portable to somewhere else, then you don't even have to worry about it. So that's a really key benefit that a lot of people overlook in this as well. So the fourth major benefit of personal insurance over creditor protected insurance or bank insurance is the cost of it. And this is probably one of the most important benefits to most people because typically when you're applying for personal insurance, you're generally looking at around a third of the cost cheaper or maybe even a half cheaper, 50% cheaper than what is being offered to you through the lender. So let's face it, I mean, if you can get a better benefit at a cheaper price, you would do that all day long, right? So cost does play a factor into this as well. Just to summarize things, there's really four major benefits that personal insurance in our minds has over creditor insurance or lender insurance. The main points being the benefit remains level, the cost is cheaper, as I just mentioned, it's portable, so you can take it anywhere you want, and the underwriting is done up front so you know that you have insurance in place right away versus hoping that you do at the time of claim. So really four key benefits to it. But every situation is different, and frankly, there's no one-size-fits-all with insurance or virtually any other financial solution. So if you have any questions about this, we're more than happy to talk about your specific situation. So feel free to reach out to us, cgwfamilywealth@nbc.ca. Or give us a call, of course, or reach out if you have an insurance broker in place already. Reach out to them as well. It's an important thing to look at, and you just want to make sure you have the best coverage possible.
I think the key point: make sure you do your research. Don't just sign into anything because it's there in front of you at the time when you go get it. Do your research so you know what's appropriate for your situation.
Perfect. Exactly. With that, ready?
Aim. Fire.